What's up, everyone, and welcome to the Tristan Clunas podcast. I know it's been forever. We haven't done this in a long time because we've been busy, but we're back in full effect, and I have a great topic today that we're going to be talking about. I also have a great guest today. We're going to be talking about multifamily properties and how to invest in them using CMHC MLI Select. So I know it's a lot of words, blah, 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 but we're going to get into it in more detail. And we're also going to be talking about an event that's coming up very, very soon. But first, I want to introduce my great guest. I have a gentleman named Mitch Parker that's been in the business for 16 years. Yes, and he is an investment-focused realtor. So that's what his main focus is on investments and people looking to buy their second, third, fourth, fifth home. And we're going to be talking to him about this program because he is neck deep into the program. And I thought it would just be a great way for my audience and for people that are watching to understand it, because it might be, if you're thinking about multifamily and you're kind of like on the fence, I'm not sure if I can get into it, he's going to make it clear. You can definitely do it. It is definitely attainable. So let's get to it. Mitch Parker, thank you so much from the Condo Source. Thanks for coming today.
Thank you, Tristan, for having me. This is fantastic.
I haven't done an intro in forever, so please just bear with me. I apologize.
I thought it was great.
Okay, I just want to make sure.
You dialed it. You nailed it.
So before we get into the topic, I want you to just kind of give a brief introduction about yourself, what you do, you get it. I know I kind of gave it like a 30-second, but I want to hear your elevator pitch. Go ahead.
Sounds good. So the quick version is, like you said, I've been in the business for a little more than 16 years now, and I'm an investment-focused real estate broker. I like numbers. I like returns on investments. I'm not so much in love with the colors of paint on the wall and things like that.
Fair enough.
And so I originally went to school for finance. I had a short career in renovations and construction after I graduated school. I actually ended up running my own company. And then through that, I found real estate investing because at the time, everybody was flipping houses. And so I said, finance background and construction crew working with me, it kind of makes sense to flip houses.
For sure.
And so we bought, when I say we, it's actually my dad and I. So we bought our first property. It was a student rental near Carleton University in Ottawa.
Nice.
And it wasn't a flip. It turned into like a reno and more of a long-term hold. And then we just ended up picking up more and more properties. And at a certain point, it made sense to get my license. And then, you've been around long enough to know, like, when you're doing something successfully, people start to go, how did you do this?
Right.
And so it made sense to start helping other people. And, fast forward, I've been able to build a good career in that investment-focused niche.
Nice. That's awesome. That's awesome. And what, because I obviously known you for a few years now, you guys have done it in many ways, one of them being pre-con. Can you talk about that side of it as well?
Absolutely. So, for a long time in the GTA, one of the best ways to make money was through investing in pre-construction.
Right.
For a few different reasons. Like, one was you could buy a property now. It was only ready in, let's say, 3, 4, 5 years. And so the value of that condo would go up between when you bought it and when it would be ready. That was the theory anyway, and for a long time, that's what actually happened. Yeah. And then the other big thing too is that there was no work to do. So you were essentially just putting your deposits down. You didn't have to qualify for a mortgage. There was no tenants, there was no upkeep, there was no nothing. So it was literally a completely passive way to earn revenue. And so we built a very successful business doing that. And then the problem is, as interest rates went up, the market had a big correction, which is like what we're seeing now. And a lot of people that ended up buying in, let's say, 2019, 2020, 2021, they may have paid a specific price for a unit, and it's now 15 to 20% lower, if not more, than what they paid. And so when we ultimately sat down as a group and we figured, okay, so most of our clients are investors. About 80% of our clients are investors. Big chunk. Yeah. One thing is they still need returns. And two, they generally don't want to create a second full-time job for themselves, being an investor.
Right.
And so it needs to be passive and it needs to generate returns. And so we started looking at some of the various options that were available. And the MLI Select program, we watched it for a long time before making any recommendations, before doing any actual deals, because we wanted to understand it like really thoroughly, so that we could have confidence in the conversation about it. And now what I'm realizing and what we're seeing is it's probably one of, if not the best ways for an investor to build significant wealth in the Canadian market right now.
That's awesome. So let's get straight to it, because you kind of did a great transition in there for me. So just to break it down for the folks that are watching, CMHC MLI Select is the name of the program.
Yes.
Explain to us what that means. What exactly does the program do?
So CMHC, if you're not familiar with it, is essentially, it's a government program that provides insurance to people who put down, most people think of it as less than 20% when they're buying their residence.
Right.
So their mandate is they want more Canadians to buy housing and have access to affordable housing. And so if you think about, if every time someone bought a property and they needed to come up with 20%, you'd have way less of the population owning homes. And so what they've come in is they've said on the residential side, you can buy with as little as 5% down. And then you essentially have a mortgage that's insured. So if TD gives the mortgage, CMHC says, this is an insured product, so don't worry, so they have the confidence. And again, it's just that scalability to get more people into the market. They have a similar product on the commercial side, which is called the MLI Select program. MLI is Mortgage Loan Insurance. That's what it stands for.
Perfect. Yeah.
And Select means that it's only going to be the best properties. They're really looking for the top tier of properties.
Yep.
And so, essentially, what they've done is they went back and they did a study to figure out how much housing they truly need to meet the supply in the market. And they said, we need about 5.8 million homes by 2030 across the country. In their planning, and where they thought they could actually hit, was only 2.3 million. So it's a massive
huge
gap.
short, yeah.
And like we saw in the GTA, what happens when you have a supply shortage and a high demand, prices just go through the roof.
Right.
And they essentially went back to the drawing board and they said, we need to come up with a program that brings in the private investor where we can meet our mandate, which is to provide more homes. And then the investor is going to be prompted and motivated enough to participate in this program.
So let's talk about that. So, I mean, so for the average investor that would have invested in those pre-construction condos or in, maybe a student rental, whatever case may be, what's the benefit for them? Why would this be more of interesting take on investing as opposed to the other stuff that they were doing before? What are the benefits for this program?
Great question. So traditionally, if you want to invest in multifamily, and the CMHC MLI program is designed for properties that have 5 or more units.
5 or more units, multifamily properties. Got you.
So it's not single independent or duplex or triplex or even fourplex. It's 5 units and above.
Any max, or is it just kind of like?
No, you can scale up to a few hundred units if you want to, type of thing.
Yeah,
and so traditionally, if you look at like a commercial product like a multifamily,
right,
you would be putting down 35%.
Easily.
Easily.
If you're lucky, you get 30%.
Exactly.
That's like few and far between.
Few and far between. You'd have generally a mortgage that would be amortized over 25 years generally. And then an interest rate, if you look at today's interest rate, you're easily in the 6s, if not the 7s, right? Sure. Depending on the scale of who you are as a client. So what the MLI has done is they've put together a program where you can buy with as little as 5% down.
Wow. So on a commercial multifamily
multifamily. So
on a 5, 6, 7, 8 plex, you can put down just 5 up. As minimum as 5%.
Exactly.
Wow.
And so like we can use real numbers.
Yeah,
so I'm working on a deal right now that's about to be finalized. The purchase price, it's a 8-unit building. It's in Edmonton, and we'll get into the reasons why Alberta makes more sense through the conversation. Yep. It's 2.4 million. And so the deposit on that is as low as 120,000 to get in.
Guys, sorry, before you continue. I bought a condo a couple of years ago, pre-con, and I paid. It was for 600,000.
Yeah.
120,000 was my down payment because I had to put down minimum 20%.
Yeah.
So you're telling me I could have easily, not easily, but I could have qualified to put down 120,000, which would have been the exact same as me buying a $600,000 condo.
And this is what a lot of investors have. This is the reaction they have. Is that? But it gets significantly better than that. So one of them is that the mortgage is amortized over 50 years,
as opposed to like a 25 or 30.
Wow. Exactly. And so, what that does is it bumps the cash flow up significantly.
Your expenses drop.
Your expenses drop. And then you have a 10-year mortgage term. So the interest rate that you're going to get is going to be locked in for 10 years. And that interest rate, whereas on a regular commercial product might be 6 to 7, like we said, in this case, it actually trends off the Canada 5-year bond rate plus around 1.1%. And what that ultimately means for numbers-wise is right now, if you close on a property, you would have an interest rate that you would hold for 10 years of 4%.
Like, what are we talking about right
So
now?
they make the,
That's just
Yeah.
They definitely make it like very beneficial for the investors and
For the investors.
Yeah, awesome. Keep going. Tell me
Okay,
other
sounds
benefits.
good.
Yeah,
And another major difference that a lot of clients like so far is the fact that it's when you qualify for the program, because that's a big part of it, is how do you actually qualify?
Yeah, we're going to talk about that right after this.
For these,
Yeah.
okay? And so you actually are not dependent on income or credit. Because
So, do you want to dive into that like fully now, or like in terms of the qualifications?
Sure,
Yeah,
we can if you want to.
Yeah, because I know there's more to it, right? So
Do you want to step back?
Yeah.
first?
Okay. So let's step back. Let's
Okay.
do this because you guys have been focusing. You mentioned Alberta. You mentioned Edmonton.
Yes.
The focus has been outside of the GTA, where your focus before
Yes.
was pretty much 99.999% in the GTA.
Absolutely.
So what changed? Like what are the differences between Alberta and Toronto? Before we get into all the qualifications, I'm curious to know.
Sounds good.
Yeah. Because before we continue, where this program works the best, from what he's going to explain, is not in the GTA, which is not common for a lot of us. But and people feel a little bit afraid to go outside of the GTA because they're like, okay, how am I going to manage it? All that stuff.
Right.
So we're going to talk about all of that.
And don't turn it off now because you mentioned it's not a
please.
GTA product.
Please don't turn it off. You're going to be the way they structure it and how we're doing it is it's going to be a program where it's going to be pretty much hands off.
It is. We've designed it totally turnkey from an investor, from actually like securing the unit right until it's closed. There's a team in place every step of the way.
Nice.
And then even once it's done, there's a property manager who literally handles everything.
So you could be in Toronto and never. Some people probably haven't even seen the property.
No, you could be across the world. You could be across the world,
right?
And the thing would be running on its own. It would be kicking out cash flow every month.
Awesome. So explain.
But
So let's go. Let's turn back and go. Explain why Alberta.
So, like you said, we did focus on the GTA for a long time, and I thought that there was a lot of opportunity here, and there was a lot of opportunity here, but to me, it's just about the economics and where it makes the most sense to invest revenue to ultimately grow wealth. And so in the GTA, we had a massive run up in prices, and a lot of people got very wealthy with that run up. Whereas now I'm starting to look at a lot of metrics, both like that are negative in the GTA. So I look at things like, what's the average household income? What's the average real estate price? What's the average rental price? And if you compare that almost like in a ratio format, so the average freehold property is now, I think the last stat I saw was just over 1.1 million.
Yep.
Now, to qualify for a mortgage for that house, the average household income is $94,000 below what you need to even qualify for that mortgage. So you're like 1.1 million, which prices a lot of people out. The average household income doesn't support that mortgage. The rental would never cover that. You'd be cash flow negative. When you look condos specifically, we have a massive oversupply. So right now there's 7 months of inventory for resale, plus a 64-month inventory of new construction. And
So
explain
that. Explain months of inventory.
Yeah, great. So what that basically means is that if no new condo got launched at our current sales trajectory, it would take over 5 years for all that condo supply to get absorbed.
And just so that they understand, before COVID, what was the average months of inventory?
So when the market was like hot, first of all, we'd sell out buildings in like a day or two.
Which is crazy.
Like an entire building. It was like
hundreds of units
absolutely
sold in a day or two.
Yeah, absolutely insanity. And then on the resale side, where it's like now we have 7 months, before we were under a 1 month supply, which is where like everybody heard about the bidding wars and the competitions and what people would do to try to secure a unit. Now it's like totally flipped on its head. And in my opinion, a lot of it has to do with the style of units that were constructed. So if you look downtown, you have a lot of studios, a lot of one beds, a lot of 1+ dens, like really small spaces. And the problem is when they're rented out, the negative cash flow on them can be $1,500 a month, $2,000 a month. And so
it's a lot, man.
A savvy investor, even if you can pick it up for cheap, who wants to write a check every month for like $2,000 to offset the expenses? And it's going to take a long time to work its way out. Will it eventually work its way out? Absolutely.
Yeah, for
Listen,
sure.
Toronto still is a global city. There's
Growing
still
city.
opportunity.
Yep.
There's still things happening that will make it a city where people want to live. But in the meantime, I just wouldn't want to place my own money or investor capital in a city that's going to stay stagnant for a long time. And so we started looking for other markets, and we started looking on like where the demographic trends are moving. And the first thing that we really saw right away was how many people were moving out of Ontario and out of BC and where they were going, and they were almost all going to Alberta.
I saw the stats. It's just insane. It's crazy. Like, and literally, it feels like it's all going there. And then I think what the second biggest market when it comes to people going into those provinces is New Brunswick. Is it up there?
So New Brunswick. So basically, like if you laid it all out on like a chart, you'd have like the migration. And when we say like the net migration, essentially what it means is like the number that people that came minus the number of people that left. So like it's your net amount. And so your net amount in Alberta on like a bar chart would be like here.
Yeah,
in New Brunswick, it's like here. And then in all the other provinces, it's like here, but like leaving.
Negative. Yeah, on the opposite side. Yes. So and Ontario's like leading that.
Exactly. Yeah. And I get it. Like, listen, it's expensive to live here and build a life here for yourself. It's something that's constantly in the news. Whereas when I was out in Edmonton last month, I was having dinner and I was chatting with like the server of the restaurant, and she had graduated from university a couple of years before that. And it came out that I was a real estate broker and I was in the city looking at properties. And she goes, oh, I bought a condo last year. And I said, oh, that's amazing. Congratulations. And she says, yeah, me and my boyfriend decided to like make the jump into ownership. We bought it actually right around here, which was a nice area in Edmonton. And she goes, it's a 2-bedroom. I said, how big? She goes, oh, it's only 1,400 square feet.
Only?
Yeah, only 1,400 square feet.
Only 1,400. That is the size of two-bedroom condos here in Toronto.
Yeah. Right. And so I guess without frame of reference, it's small.
Yeah.
And my next question to her was, do you mind if I ask how much you paid for that condo?
I'm very curious.
And the answer, it still shocks me. She paid $265,000. Oh. And what I actually took from the story, though, is if you look at the average homeowner's household income and the average price of property. So in Vancouver, you're spending over 98% of your income just on your shelter.
Right.
In Toronto, you're spending 77% of your income on shelter. In Calgary, it's 42%. And in Edmonton, it's only 33%.
Wow.
And what it means is, it means so much more than just shelter. What it means is now you have disposable income that you can go out and live and invest and build a future for yourself. And ultimately look back and say like, I like living here because I'm able to have like an entire life.
Right.
Whereas that's a struggle for a lot of people here in the city and in Vancouver and places like that. So, and you see that with the sentiment. I mean, the optimism in a place like Alberta is total opposite of what it is here. You know, first of all, there's construction on every corner. You see people talking well about the economy. There's jobs that are being created. There's massive infrastructure projects. You know, so to tie into like why Alberta makes a lot of sense, it is the interprovincial migration. It's the fact that when you do buy a property, you have no land transfer tax, no development charges. There's no HST, there's just GST, which you can roll into your mortgage. And then now we have the federal program, which for first-time buyers will actually rebate the GST back if you're a first-time buyer, up to $1.5 million. And then we also have things like the landlord-tenant board. The laws are very different in Alberta. So in Ontario, like, I've had tenants who haven't paid their rent or could have not paid their rent for like 9 months, a year.
Which is crazy.
Right? So every
time...
time...
You can even get higher than that depending on the situation. You just continue to reset it, like, you know, the process.
And so like the problem is like every time someone doesn't pay their rent in Ontario, which like I've had, you get nervous.
Right.
Because you're like, how long is this going to go on?
Right.
The bank still wants their mortgage payment, right? The city still wants their property tax payment. If it's a condo, they still want their maintenance fees. Whereas in Alberta, it's 14 days, and then they're out. And if they want
14 days of non-pay.
That's it, and they're out.
And they're gone.
And if they want to appeal it, they have to have like a legitimate, justified reason to actually appeal it. Like just appealing it because you didn't pay it doesn't fly with them.
So Ontario is tenant-friendly?
Super tenant friendly.
And Alberta is landlord friendly.
Landlord friendly. There's no rent control there either. We see that in the newer buildings here, obviously.
2018 and above.
2018 and above, but no buildings there have rent control. And then the other thing too is that at the end of a 1-year lease, it's like a mutual agreement. So in Ontario, it's totally up to the tenant what they do.
They have full control pretty much, unless you move in.
That's right. Yeah. And even that, like, if the tenant wants to make your life miserable, they can like bring it to the board, and then you have to start like proving it.
I've seen it.
Right. Whereas like in Alberta, you can go, you know what? It's been a great 12 months. I think it's best we just go our separate ways.
It's like breaking up.
That's it. Exactly. You know,
this has been fun.
It's not
been
you,
fun.
it's me.
Yeah.
But
that's awesome.
So there's a number of different protections in place like that to ultimately protect the landlord, which when you think about it, they're the ones that are really driving the economy and the GDP, and they're buying the housing. So there should be proper laws in place to protect them.
I agree. So let's talk about how one gets into this. Like, what are the qualifications? How do you get approved for the program? I also would love for you to give me an example. You kind of touched on one with the Aplex, but kind of walk me through, the whole procedure of getting approved with the program, and then, what happens after that, like finding the property or finding the land, all that stuff. Give me the full picture.
And just stop me as you want to poke in more questions, okay?
Yeah, so first things first, give me an idea of what are the qualifications, how do you get approved?
So the qualifications break up into two components. So one is the property itself, and the other is the investor. So the property itself, CMHC has 3 different silos that properties fit into the program under. One is affordability, one is sustainability, so think like green living and things like that, and the other is accessibility. Accessibility like wheelchair ramps and elevators and showers that you can spin around in and on a wheelchair and things like that. We are primarily focused on affordability because for us, it's just a return on investment at the end of the day.
Numbers make sense and you're good to go.
Green living is great, and if somebody really cares that much about the environment, you can simply say to the developer, hey, you're building to this spec right now, we want you to build to like this spec. So it's easy to incorporate it in if somebody wants to, but I've never met a tenant who's willing to pay more for like solar panels or like a green roof or energy efficient windows, right? So we really focus on that affordability component, and the basic premise is CMHC has like a program where you get points for specific things that you do. And the goal is to get 100 points, and that maxes out the benefit to the investor. When I say 100 points, the straightest path to get there is you offer 25% of your units at what CMHC deems affordable.
Right.
I know that was like a lot of lingo back and jargon, but what it essentially means is they create a benchmark price for each city through the country, and they say 25% of your units need to be rented at or below this price.
Benchmark price, yeah.
To give you like a sample, so in Edmonton, that number is $1,665 a month.
Okay.
So if you have an 8-plex, 2 of your units would have to be at or below $1,665. Now, the great thing that we utilize is that CMHC only cares about the dwelling unit itself. You can charge extra for parking. In Alberta, you can charge extra if they have pets. You can charge for a storage locker. So you can raise your top line revenue beyond just the suite.
The base rent, yeah.
And then CMHC will just say, as long as your units are rented, and it doesn't matter like the size of your unit, where it's located, that really becomes the criteria for them and for the property that they're looking at. And then when we switch to the buyer side, so the buyers, again, not dependent on credit or income, dependent on net worth. So when I say that, somebody needs to have a net worth of 25% of the value of the property.
Give me an example.
$2 million property, keeps the numbers super simple. You need a net worth of $500,000. And that can be a combination of equity in your house, lines of credit, gold, stocks, bonds, TFSAs, RSPs. If someone has like a whole life insurance, the cash value of the policy.
Only in Canada?
They have to be in Canada. Yeah, assets have to be in Canada.
So just to recap what you said, the person, this is not based on the individual, like buying a residential property.
No.
Where you're looking at your income, your credit score, obviously down payment, all that jazz. This is mainly focused on the actual property. So they're looking at, does a property, does a land, does what you're trying to do qualify as opposed to you as the individual.
Yes.
But obviously there's minimum requirements, as you said. So you have to have 25% net worth.
Yep.
Obviously, you have your down payment. What about credit score?
So credit score is not relevant.
Credit score is not relevant.
So they're not looking at that. But what they want to see is that you have liquidity. So of that 25% net worth, 10% of it is liquid, meaning it's cash, lines of credit, things that can be converted into cash within, let's say, a 24-hour period.
Right.
And the easiest way to understand the program is to think about it through the lens of CMHC. So their goal is to provide additional housing to keep pricing under control. And through that, they ultimately want stability. So they don't want somebody who's like a first-time investor throwing their life savings into this thing that somebody hopes and prays works out for them, right? CMHC very closely scrutinizes the property, and they actually act almost as like your due diligence partner on it. So they're not going to take, like, no one can send them a pro forma and say, this unit's going to rent for $3,000 a month. And they just like believe them and sort of advance them the funds. It's like they're going to put their own numbers in there. They're going to do their own calculations. And what they ultimately need to determine, and this is fantastic for the investor, is that for every dollar of expense that the property incurs, it makes $1.10 of revenue. And that component of the program basically means that all of these properties have to be cash flow positive.
Which is unheard of here as what we're experiencing right now in Ontario.
We have clients now that have closed pre-construction that they bought in 2019 that are writing like the checks for $1,500 every single month, negative cash flow in Toronto condos, right? Whereas like this, you can't even get into the program if it's not making at least 10% more revenue. And like that 8 unit that we're just working on now, it actually had, it's called a debt service coverage ratio, to get a little technical. It was over 120.
Wow.
So really healthy numbers, really positive cash flow. Like that property that's 2.4 million will probably cash flow once it's done around, conservatively, could be $35,000 a year.
A year. Which is the complete opposite of spending $35,000 out of your pocket every year. So that's where why I love this program is they're not even going to entertain it unless it's cash flow positive.
No.
Whereas we us as investors, we probably get ourselves into something that can be you're coming out of pocket a couple $100, maybe $1,000, maybe $1,500. In this situation, you are guaranteed if they're going to qualify this or approve this property, you know that it's pretty much going to cash flow positive, which is amazing.
And it becomes like if you buy a condo. You think about like if you buy a condo or like an individual house, you're buying at like the retail level, right? You're going to the developer and you're saying like, I want to buy a 1-bedroom condo, and they give you the parameters and the deposit structure. It's hard to scale that, right? Because like you need to keep coming up with funds and you need to qualify for mortgages. Like talk to a mortgage broker when you have like five mortgages.
5 is the number, magic number.
It starts to get challenging, like no matter what, because ultimately banks want to lend to people who are living in the property themselves at the end of the day. Whereas like this, because it's based on net worth and because it's based on like liquidity and the property primarily, it's very easy to buy one 8-plex, let it run for like a little while to establish the financial baseline. You can then use that property to re-leverage and actually extend the mortgage on it. There's it's a term called pari passu, and it's Latin for on equal footing.
Okay.
And what it essentially means for the investor clients is, on a regular residential property, you can either pull out equity by taking like a second mortgage or by refinancing through like a home equity line of credit.
Right.
On the CMHC MLI Select, they actually place an additional mortgage on the property at the same terms and conditions as your first.
Wow.
So think of it as like an extension.
Yeah.
And so in many instances, you have the ability to possibly refinance once it's stabilized, pull out all the money that you put in, because you only have 5% in.
Right.
You have nothing into the deal, and then you can scale and go buy more.
And once you're in the program, you're in the program, essentially.
It's kind of like a club. So once
awesome.
CMHC looks through your assets and everything and validates that, yes, you're good to participate, it becomes much easier to buy additional properties. Now, the most extreme example that I saw was when I was out in Edmonton. I met with a number of different developers and investors. One investor in 3 years had gone from 0 to 1,000 doors.
Dude.
Yeah.
Holy smokes.
And that, like, the person watching may say, I don't want 1,000 doors.
Sure.
And that's totally fine, but you can buy one 8-plex, use the cash flow to pay it down as quick as possible, and essentially have like a completely paid off mortgage that you can then utilize for living, but also pass down to generations, which is super common with multifamily. Or you can keep taking that equity and flipping it into more and more and more. And it becomes interesting once you hit like 80 doors, 100 doors, because it becomes very attractive to like a big fund who doesn't necessarily want to do the construction part of it.
Or even the legwork and all that. It's a complete portfolio ready to go.
Exactly. And so you can spin it off to them turnkey.
And sell it.
They'll acquire it.
Right.
So you could sell it to like an individual, but what many people do is they scale it up to like a big property portfolio.
Now, one of the most important parts of this program that I like as well is, as you said, it's not the individual. So you can put this in a corporation name.
Yes.
And can you have multiple partners in that corporation that you can go ahead and buy a property with?
So I wouldn't ever recommend somebody even buying it in their own personal name. First of all, because it would be all the income would go right on top of your own income, and then it'd be taxed like through the roof.
Yeah.
Alberta has the lowest corporate tax rate in Canada, and so very tax efficient vehicle. And if you actually draw income from it, then there's very strategic ways that like an accountant can set it up.
Right.
So when you have the corporation tax efficiency, but then also like me and you could each become directors of a corporation, combine our assets together, and be able to qualify for this program.
So again, very important. If you're someone that doesn't have, let's say if we're looking at 2,500,000 as net worth, you don't have 500,000 in equity, why don't you partner up with somebody? Partner up with someone else that has that, and you guys split the down payment, for example, that way. And if you have 250, they have 250, you guys can combine each other's net worth, and then also come with your down payment split it down the middle as well. So it just gives you way more opportunities in order for you to invest and not feel like, oh my gosh, how am I going to do this? Buy an 8-plex, I have no idea I'm going to get involved. I don't have that kind of equity. But if you have assets, if you pick somebody that has assets or someone that has maybe the down payment and you have the assets or whatever the case may be, you guys can split it. Or 2 or 3 people, obviously people that you trust. I just think it's a great opportunity for people to actually get into multifamily properties. It's not as scary as it was before. Yeah.
It's not, and this program really opened it up to a lot of additional people to be able to participate.
Right.
And if you look at where wealth in real estate historically has been created, it's not in buying single units.
Right.
It's like you look at the big players in the city, and they own like 1,000 doors, 500 doors, 200 doors of multifamily property.
Right.
Many of them have used the MLI program to enable them to scale like this.
Okay, so let's walk through a typical situation. Give me an example of somebody coming in. They want to. By the way, I'm going to be doing a program. We're going to be doing a seminar on this. So July 9th is already booked, it's ready to go. So if you want to learn more, if you have any questions, please come out. We're going to be promoting it, pushing it big time. So July 9th, keep it in your calendar in Toronto. But if you have your investor that's ready to do this program, walk us through the process. What does that look like? So
the first thing they would do is obviously they'd call you.
Of course.
That's what you have to do. You got to call Tristan. And then what would happen would be we would have a conversation to explain all the program in full detail. Because obviously we're only able to go high level on a conversation like this. But we go over the program in full detail. When the person ultimately says, yes, I think this is something that's good for me, we put them in contact with a specialized broker who knows the MLI program backwards and forwards. And the qualification process is actually quite simple. It's more of like a statement of net worth, and we just figure out where the numbers are. And once we know that, then we can actually start looking at different opportunities. And so, like you said earlier, it can range between 5 units to a few hundred units, and depending on what the investor's net worth is and what they want to do. So we start actually shopping. Once we find the property, what's great is the investor puts a deposit, generally of about 2.5% down, but you get what's called a cooling period. So it's the same as when you're buying like a pre-construction condo. You get 10 days, sometimes 2 weeks, to ultimately have a lawyer review the agreement, to do your due diligence, to look into who the developer is, if you want to fly to Edmonton or Calgary, you can fly out there. We've had clients do that. And so whatever it takes to get comfortable with the deal, you do that over like the 10 days. If for whatever reason you don't like it or don't want to proceed, you just cancel it and walk away. It's like the deal never happened. So it's great in that regard because it takes the pressure off of deciding am I in? Do I want to do this? Am I committing? It's like, just secure the property, give yourself a few days to like breathe, come up with the questions that you didn't even know you had questions about.
Of course.
We work with all of our clients through that period to make sure that they're 100% comfortable. After the diligence period is over, assuming everything is good, the deal goes firm. We give the balance to 5%. So in this case, would be like the second 2.5%.
Yep.
The mortgage person will then secure the lender if they're a broker, or sometimes we work with somebody, let's say for like RBC, who will then secure the funds. At the same time, what they also do is they send the file with the property and the borrower, the investor, to CMHC.
Gotcha.
To issue what's called a certificate of insurance, which often is referred to as like a COI. Okay. That takes 60 to 90 days.
Okay.
If for whatever reason you don't get the COI, you get your money back, and it's like the deal never happened.
Wow.
So the deal's contingent on that.
Wow.
But we generally know ahead of time what the parameters of the investor are, what they'll qualify for, and the property will qualify for it as well. So it's rare that there's sort of a fall through in that period of time.
But you still have that.
But you still have it.
Yeah, it's conditional on that approval.
Exactly.
The approval of CMHC.
Because without it, then you don't have CMHC,
Right,
and now
and
you're putting at least 20% down, if not more, on the property, right?
different situation.
Changes the whole program.
Yeah.
So once we have the COI, the funds are advanced to the developer, and that's where we have like a number of different development teams that are all experienced. They have all built stuff like this before. We're not working with any first-time developers.
That's a great question that people have.
And so what they do is they start construction usually within days. And if you're talking like an 8-plex, a 10-plex, within 12 months, the property's finished. If it's a bigger property, it can obviously take a little bit longer.
Sure.
But there's no red tape in Alberta. You can get through any sort of approval and zoning process a lot more efficient than you can in a place like Ontario. And all along, the investor just gets to hang out and watch this thing get built. And so the bank will issue funding to the developer in draws. So like they have to hit specific milestones. They hit the milestone. Someone from the bank will actually go out there and confirm that like, yes, you did do all of these things. Okay, now you get the next tranche. So there's like a number of safety mechanisms in place to protect the investor. And then about 2 to 3 months before the property's ready, we'll bring in the property manager. They'll start to market that property. And we're looking in areas specifically that have good demographics, a good tenant profile, a good household income. And so when you add like a brand new property to that mix, where the finishes are like absolutely stunning, way beyond what you'd get in a standard condo here, now becomes very attractive to a lot of potential tenants. And then the lease up begins.
Right.
With the ideal thing being that we lease out all the suites, but if not most of them, are generally leased before the condo even, or the property even closes. And then on closing, keys are transferred. There's no development charges, no land transfer tax, none of that. So your closing costs are significantly, like tens, if not in some cases hundreds of $1,000s cheaper than what they would be in Ontario. And then the property manager at that point will either like rent out the remainder of the units, or if they're already rented, now they're just doing their thing and you're just collecting money at the end of the day. So that's when I say like it's a passive approach for a lot of investors, because there literally is nothing to do. If somebody really wants to go to Edmonton and manage their own property, like they have control of everything. It's just most people don't want to do that.
And CMHC would have done the numbers based on you hiring a property manager as well, right?
Yeah, like they don't care if you manage it or not. Right. They're still going to input their numbers. So they have like...
So the numbers work with you being completely passive, not touching the property.
Absolutely. Like when we say that like 1.1 coverage ratio, we mean like all the expenses for management, like you said, putting a reserve aside for down the road when things do need to be replaced, any repairs, any maintenance. All these buildings come with warranty. So generally in the first couple of years, you're not going to have any expenses, because if something goes wrong, the builder has to come back.
And is the warranty similar to what we get like Tarion?
Yeah, so in Alberta, it's a little bit different. It's held private companies. In many instances, it's actually better than Tarion.
Yeah. That's amazing. I mean, I think the people that are watching, if you got this far, you're definitely interested in see why I was like, we need to have this conversation right away. Is there anything else that you would want to share that's missing in terms with the program or with investing in Alberta, all that stuff? Anything that we're missing here?
I think it's really easy right now to stay comfortable and hope that GTA real estate comes back, or I'm just going to keep my money in a bank account until it comes back. And, inflation is high. I don't think interest rates are going to fall as quick as what some people think they are. And I think we're going to have a lot of challenges, like we said, in this market for a long time. And when we look back at like the last Great Recession that we went through in Canada was 1989.
Yeah.
And in the GTA specifically, the average freehold property at that time was $270,000. So way cheaper than it was now. But the primary causes of that recession it was a war between Iraq invading Kuwait, which caused the price of oil to double between July and October of that year. It was the inability to lower interest rates because of inflation. It was record budget deficits ran by the government. And it was a lack of technological advancement by Canada compared to like other global countries. And if you look at that, what we have now is we already had Ukraine, Russia.
Yeah.
We now have Iran, Israel,
yeah.
and US-Iran situation pending. We have high inflation that's preventing us from bringing down interest rates. We have a liberal government that last year just ran the third largest deficit in the last 35 years.
Right.
And we have some advancement in technology, but nowhere near what other countries are doing. And so I'm not saying that like we're headed down that path again, but when it happened in 1989, it took 12 years to recover back to that price. So if you're an investor, that's it. Like a decade seems like a lifetime.
For sure. To be sitting on the sidelines. Like,
to be sitting on the sidelines. And some people will. But I think as somebody who's looking to build wealth and a real estate portfolio and just ultimately like financial freedom, you have to start looking outside your own little neighborhood and community, but look for strategies and ways that are going to prevent you from having a full-time job,
right?
And prevent you from not sleeping well at night,
right?
Because I really do believe that like a peaceful sleep is worth its weight in gold,
for sure.
But if you have all these things in place, like a property manager, like a government organization vetting the entirety of the deal to make sure that it's supposed to be what it's claiming to be, it should give you a lot of peace of mind as an investor that this is a really good opportunity and ultimately a great way to sort of get back in the game confidently and then decide, do I want to scale? Do I want to buy one? What do I want to do with it? But at least you'll have like options at that point. Because the alternative is as inflation keeps rising, everything's going to keep getting more expensive. And so like the power of your dollar tomorrow is not as powerful as your dollar today. But it's definitely worth exploring the opportunity. So I say like if somebody's watching this right now and this resonates with them at all, definitely reach out to you. Let's set up that meeting just to get them the 100% picture to figure out if it's something. And if it's not, that's okay. You'll be able to find them something else that does work for them.
Yeah, and at least they learned about the program. They know of the option.
And knowledge is power.
For sure.
Right? In this day and age, knowledge is power. And so I would definitely say come out and like reach out to you and figure out if it's something that could work for them if they're looking for an alternative. But absolutely don't wait on the sideline for 12 years because it's not going to work out well.
There you have it. I mean, there's nothing else to add to that. This is the reason why him and I have been having this conversation about this for a few months. And I love the way you handled it because you want to kind of see what it's like first, do your own due diligence and the whole nine, get some clients in it. And now for you to be able to speak on it and to see the growth in your knowledge on the actual program and doing it for yourself, which is, I mean, it's amazing. That's the reason why I want to jump on it. That's the reason why I'm going to have a seminar July 9th. Please come out, even if you feel like you're not in a position to do this right now, come out and learn about it. As he said, knowledge is power. Please come out. July 9th is going to be in Toronto in our office. We're going to have a great time. We're going to have refreshments and the whole nine, but we'd love for you to come out to learn about the program because you'll be surprised what you can do. Please like, subscribe, and comment down below so I know, if whether or not you like this topic. If you have any other topics that you want to talk about, please let me know. I'd love to know. So just put it in the DMs or comments, the whole nine. And yeah, Mitch, July 9th, we're going to rock it.
That's it. I hope you guys come out.
And it's going to be more detailed than this. We're going to actually go through all the stats and all the information on July 9th. So
it's a deep dive.
Yeah, this is more high level. We're just going to give you guys an understanding of it, but it's definitely a deeper dive on July 9th. So look out for it. And remember, clueless, ask clueless. Have a great day.